the most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
It is 2 p.m. in New York, 11 a.m. here in California. We are live from the Academy Museum of Motion Pictures right here in Los Angeles. This is a very special edition of Bloomberg Markets The Close with the entertainment edge. I'm Caroline Hyde.
Yeah, the entertainment edge. Of course, we're just overlooking Wilshire Boulevard here in Los Angeles. I am Romaine Bostick. Coming up this hour, we're going to speak to a really big lineup of folks here, not only about the entertainment industry, but of course, we're going to keep an eye on the markets as well. Chris Brightman of Research Affiliates, he's going to be joining us in just a moment. Robin Young of Behaving Wealth also going to be here. And Caroline Stein, Harold.
Yeah, we want to be talking about the restaurant industry, about how people are coming back, tourism, how it's affecting it, the labor shortage. And then we're going to dig into the media landscape. Dr. Patrick Soon-Sochong is going to be in with Immunity Bio, but also happens to own, well, the most important LA newspaper here.
Well, I've heard. Yes, he's a very important person. Taylor, you're also a very important person. I'm sorry you couldn't be here with us. We're going to bring you back something nice, maybe some sunshine. What's going on in New York?
Yeah, I better get some souvenirs out of this trip, you guys. Let's take a look, because the equity markets remain perhaps are missing a little bit of that sunshine. We're coming off of the record highs that we had yesterday. 45.49 was the level, so you're off 9 points or so from that. The Nasdaq is actually the biggest underperformer, and this is really interesting because you're seeing yields come in a lot on the long end. We had a lot of comments from Jay Powell in the 11 o'clock hour here Eastern, but tech is still the big underperformer. Why? Snapchat, wow, having its worst one-day drop ever. This is after it's so interesting. We'd all been talking about Facebook and the concerns about the Apple iOS change to add privacy. No one knew this, but Snap is actually getting really hit hard by this. Where was management? Why didn't we any get a concern or a heads up from them on this? That is a key question from analysts coming this morning after those earnings yesterday after the bell. As I mentioned, 10-year yields also really coming in about 4, 5, 6 basis points really further out on the long end. Why? Well, you tell me. We're having our 5 and our 10-year break-evens rise to 15, 16-year highs. So yields are coming in maybe because Jay Powell did say we are on track to taper, and inflation and some of these bottlenecks, well, he made it clear that those risks are clearly tilted to the upside on this. And so you are seeing some of these break-evens really start to climb, Caroline.
Well, we've got the perfect guest, Taylor, to be discussing a little bit more about the supply chain issues they see right here in California, some of the inflationary pressures that Powell was talking about. And then, of course, it was a panel led by our own Francine Lacroix who was discussing this. Let's discuss it all with Chris Brightman, Research Affiliates partner, CIO, CEO, a man who knows, well, the bottlenecks, the tension this puts upon the industry and indeed upon the entire markets right now. Where do you stand in terms of inflationary risk?
I think inflationary risks are elevated. The central tendency expectation, that we can see in the market for bonds, the difference between tips and nominals, otherwise known as break-even inflation, is sanguine, elevated for a couple of years through getting through the reopening of the economy and then settling down back a few years forward down to just above 2%. But the risks to that central tendency, I think, are elevated, particularly to the upside. We're running at 5% inflation. Even the trimmed inflation, the kind of underlying rate of inflation, there are multiple gauges that the Fed uses.
Out everything that we use, like energy,
food, the necessities. Yeah.
And all the outliers, and it's still running at 4%. So we're clearly running at an elevated rate of inflation, but the market's betting that it comes back.
Well, I am curious about how you mitigate that risk, particularly from a monetary policy perspective. We did have some headlines a little bit earlier, Jay Powell talking about inflation, signaling a degree of concern that maybe, at least publicly, he hasn't necessarily signaled in the past here. Is the Fed too late to the party here?
I think in this particular instance, it's less about the Fed and more about monetary policy. We had the great disaster relief payments.
Fiscal policy.
Fiscal policy, right. I'm sorry, yes. It's more about fiscal policy. We were, wire transferring huge amounts of money into people's accounts, as well as monetary stimulus, QE, but it's really when you coordinate fiscal and monetary, that's how you get inflation.
Well, I mean, and that's a great point. I mean, you talk about the big recession we had. The first time you saw a massive contraction in GDP, yet an increase in actual household income. There's more money, though, potentially coming down the pipeline, at least if the Democrats get their way. Is that troublesome?
Well, it depends. I think from an inflation risk perspective, it is troublesome if we enact a lot of new social programs and don't pay for it with tax revenue. Again, that's a recipe for continued high inflation. The market's betting that's not going to happen. On the other hand, if you're looking at corporate profits, that's great for corporate profits. There's an accounting identity, sometimes called the Kalecki profit equation, that basically says that an increase in government savings, which is government deficits, flows either into individual savings or into corporate savings, and double entry bookkeeping says corporate savings are basically another word for profits. And if you hold individual savings constant, higher deficits mean greater profits. So all of this deficit spending we've been seeing over recent years has flown directly into corporate profits. If that were to turn around, and there's no indication with what's going on in Washington today that the deficit spending is going to end. So if you're accounting on corporate profits, yay, deficit spending.
Let's talk about your investment choices right now, of course, of CIO. When we're looking at, people looking at growth stocks, technology, sometimes as a haven, sometimes as what might be able to pass on costs, not be able to weather inflation. But you look at a Snap, chat, of course, Snap, the owner, based right here in LA, having a torrid time on the market today because it underwhelmed in terms of its future growth. There is some concern about, of course, its business model related to Apple. But are growth stocks a potential haven during inflationary pressures, or should you be looking more at the energy stocks, the cyclical nature of things?
No, I don't think that stocks in general are going to be a haven from inflation, and certainly not the high-flying growth stocks, because the sensitivity to the discount rate should be much higher to them. They have much more distant future cash flows. So that's generally when you see an inflation scare, we see the Nasdaq underperform the S&P and the Dow.
But big tech sometimes manage to weather it.
Yeah, well, I think the idea of interest rate sensitivity is a little bit overblown. You can think of the profits generated by Google, Microsoft, Apple, Amazon as being, depending on your political persuasion, if you could think of it as having a moat around your business, as Warren Buffett might call it. A progressive might call that monopoly rents. The risk, I think, to those companies is less about inflation missing to the upside by a couple of percentage points for a year or two, and more about policy that's designed to address the lack of competition. And, make no mistake, there are a number of people on Biden's economic team who intend to address this. Whether they're successful remains to be seen.
Well, what about value, I guess, in the more traditional sense? I mean, obviously, Research Affiliates has done a tremendous amount of research and investing in that space here. When you look, and more importantly, when you try to define value in this environment, what is it?
It's an enormous dispersion between the pricing of growth stocks and value stocks. We're not at the highest valuation dispersion ever. That would have been about this time last year. But excluding that period, we are at the widest dispersion, the biggest difference in the pricing of growth stocks versus value stocks. And just based upon what was happening over the last day or two, I'll give you a trade that kind of gets at the essence of what we do in our contrarian value-oriented investing. While I don't have deep expertise on individual stocks, when I see Intel trade off based upon a very temporary issue, so far as I understand, Intel missed on top-line revenue because folks like Compaq and HP are constrained in some of the parts that they're getting, and so they reduce their CPU orders. That's going to come back. Why Intel should trade off so hard? Now it's priced at less than $50 a share at 10 times PE multiple. You know, the market's 25, 30 PE multiple, really hard to get a decent return from those prices. But that market price hides this enormous dispersion. And so shorting WeWork's recent SPAC IPO against going long Intel.
Is that the pairs trade, WeWork, Intel?
Yeah, I give it as an illustrative. You know, we tend to have a diversified set of positions that we're long on cheap stocks that have recently had some trouble, like Intel, and we tend to avoid stuff that you can't even figure out how to price a company that never has made money and continues to burn cash. But those are the opportunities that present themselves in today's market.
A lot of opportunities, and the folks over at Research Affiliates always find a way to sniff those out here. Chris, great to see you. Great to see you in person out here in LA. That's Chris Brightman, Research Affiliates partner, CIO and CEO, helping us kick off the show, of course, live from the Academy Museum of Motion Pictures here in Los Angeles. A lot more coming up on the show. We got a conversation coming up with Robin Young.
Yeah. Certified financial planner, CEO of Behaving Wealthy. Her insight on building a career in finance, whether it's better to pursue MBA or over CFA. Taylor, I know you have thoughts, but also...
this debate again.
Yeah, but also addressing inequality, right? How can we help build wealth?
And we're also going to talk about the challenges in the restaurant industry. Caroline Stein going to be joining us, a big entrepreneur, restaurateur, I should say, right here in Los Angeles. She's opened 3 new restaurant operations this year. That's a challenge, right? Yeah,
talking of these labor shortages, how is she managing to look through them?
And Dr. Patrick Soon-Shiong, the billionaire founder of Immunity Bio, and of course you probably know him as the owner of the Los Angeles Times and the San Diego Union Tribune. He plans to build a complex in South Africa to produce vaccines for COVID-19 and cancer. He's going to be here to talk all about that. So much more coming up right here in Los Angeles to our viewers worldwide. This is Bloomberg.
Romaine and Caroline out in Los Angeles, and it is a Santa Monica company today, of course, that we are ironing in on. Take a look at shares of Snapchat having the worst day ever. And it was interesting. MoffettNathanson pointed this out. Facebook had warned us about the changes to the Apple iOS software. Snap said they weren't worried. That story changed yesterday. Let's do it all with Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence. And Mandeep, why weren't we perhaps maybe given more of a heads up by Snap that the changes to the Apple iOS software was indeed going to impact them?
Well, look, 2 things happened here. One is ad pricing. When you think about, the industry auction-based mechanism, that has peaked simply because with the IDFA changes, what has happened is advertisers are seeing lower returns on ROI for their ad spending dollars. Part of that has to do with, the fact that these companies can track user activity outside their apps, so less data available for ad targeting. And in Snap's case, the stock was priced to perfection in terms of their rich valuation. I mean, they were trading at over 20 times sales. Everybody else is around 10, 12 times sales. So the room to miss was literally like marginal, and they kind of came out with a very muted forecast, and that is why we saw, such a wild reaction in the stock.
Mandeep Singh of Bloomberg Intelligence, really appreciate your time. Wish we had more time with you. Love some of that insight that you give us. Romaine, out to you in, well, not Santa Monica, but LA.
Out here in Los Angeles. Santa Monica's not that far, Taylor. Maybe that'll be our next trip. We'll just stay out here for another week, but coming up right here.
If shares keep falling 24%, maybe we should.
Yeah, we should. I gotta get my shades back on. MBA or CFA, that's a big debate that we once had, Taylor. I think I won that debate. Now we have a guest who was actually part of that debate, Robin Young. She's the CEO of Behaving Wealthy. She's going to be joining us right here on the set, not only to talk about that, but really just to talk about investing here, education, financial literacy, and more importantly, closing the wealth gap.
Inclusion, that's where it's at. This is Bloomberg.
All right, going from one coast to the next, New York to Los Angeles. We've got the Academy Museum of Motion Pictures here. We're actually going to talk not about entertainment in this segment, but about wealth, about inequality, and about maybe how you address that.
Yeah, something that you see both in New York and here in the state of California and LA. Of course, the haves and the have-nots. We know the wealthier keep on getting richer. The poor left behind. We need some financial literacy, financial inclusion, and we've got the women perfectly placed for that.
Robin Young, she's a certified financial planner and CEO of Behaving Wealthy. Robin, great to see you in the flesh.
Nice to see you all again.
We've spoken with you before in the context, particularly of how African Americans and other people who maybe didn't necessarily fit into sort of the traditional world of finance, and how we've reached the stage now where there's a lot more awareness about being included in that, and more importantly, inserting and assertive yourself into that.
Yes, well, I found that credentials open the door for you. So whether it's a CFA or an MBA or a CFP, they can really open the door. But then you have to build soft skills to actually turn that into actual success.
And soft skills, marketing skills. We're in the home of content, creation content, making your voice heard. How have you ensured that your business remains relevant and is getting, well, its message across to the right people?
Yes, well, my favorite group of people I call the emerging wealthy. And it's because they're income earners, but they haven't yet turned their income into freedom or income into wealth. And so my client is the person who says at the end of the year, where did my money go? Like, I don't have enough to show for how much I actually earn. And so it's really important that you understand that there are certain money habits that you must exhibit in order to turn income into wealth. That's the key.
Well, let's talk about those money habits, because for a lot of people in the Black community, particularly of another generation, my generation coming up, it was all about, well, just save a certain percentage of your paycheck, or don't spend as much on some of the more frivolous consumer goods. But a lot of younger people, they're looking at that and they're saying, that's not going to cut it.
Correct.
Yeah.
And actually, it was an incomplete lesson when we were younger. So a more complete lesson happened. I managed about $1 billion for 500 clients when my previous job before my company, and I learned these wealthy habits. And income earners didn't know these habits. And so I said, what if I could help them learn these habits? So some of these habits are, what do you really want? Income earners can be vague about what they want in the long term. Wealthy people always know what they want. Number two, know it. They have to know, how much does it cost? Where are you in relationship to your goals? Number three, how do you actually turn your income into wealth? How do you take your income and then allocate it towards those goals? Wealthy people are so focused on that. Income earners, on the other hand, are like, well, here are my expenses. This is kind of what I want to do, and we'll see what happens. And so those habits can, I'm telling you, it's the difference between wealth and freedom and that rat race of spending and earning and spending and earning.
Well, Robin, at the moment, we are starting to see, well, a more disruptive kind of finance, a more, we call it the democratization, the Robin Hoods of this world, the ability to very cheaply put your money to work in assets, whether it be index funds, whether it be crypto, whatever you might name it. And is that how you're saying that you need to put your income to work? How are you saying safely you can build and for the long term?
Very good question. The first thing you have to understand are what do your goals cost? Most people don't know how much their goals cost, because once you know that, you know how much of your income to allocate there. It doesn't matter where you allocate it if you don't know what it needs to do. And so the first piece is what do you need it to do? And then you have to balance growth with preservation. How long does it take you to actually grow that money? And then you want to make sure you protect it. And I find that younger people don't always think through that balance of growth and preservation. So when you say, what can you do? You first have to say, where are you going? What return do you need to get to your goal? And then do so. I always say, listen, very simply, be very simple. Your first $500,000 should be a simple exercise in investing. Very simple.
But when we talk about growth preservation, that line is risk. And the risk that people are willing to take, but more importantly, what they're capable of taking.
Yes, and part of risk is understanding your stomach. A lot of people will say, if you're young, you can be aggressive, you have time. But what if you're young and you have a low tolerance for risk? So you have to pay attention to that. Or you're older and you have a high tolerance for risk. So you have to be able to balance, okay, let's protect my money and then grow. So for example, I always use this example. If you have $100,000 and you lose 40% of that, you have to return 67% to get back to $100,000. Let's protect what you have first.
And very briefly, is there enough financial literacy going on here in LA, in Venice, where you live? How are you targeting people at a younger age to understand this?
Yes, there is not enough financial literacy, but part of it, there's this myth that if you don't have a lot today, that you should wait until you have a lot. And that is the absolute wrong message. The right habit is, what are you doing with the income that you have today and turning that into to actually returns. So I say this, one rich behavior should yield you 3 times richer results.
Robin, so great to see you.
Yes.
In the flesh. Robin Young, she's the CEO of Behaving Wealthy, joining us right here in Los Angeles. We're on the Dolby Family Terrace atop the Academy Museum of Motion Pictures, broadcasting live today to our viewers worldwide. You're watching Bloomberg. All right, live from atop the Academy Museum of Motion Pictures, this is a special edition of Bloomberg Markets to Close. I'm Romaine Bostick.
And I'm Caroline Hyde. Taylor, you're holding down the fort in New York, and it's all about that time. It's commodities close.
My last day of commodity close. Can I do it? First, let's take a look at crude if we can pull it up here. Earlier, we were looking at higher, and indeed, you're at an 83.75 here on crude. You're now up on oil for 9 straight weeks on a weekly basis. We're at the highest that you've now seen since October of 2014. Nat gas is up 3% as well. I'm going to touch a little bit on that later. But aluminum, copper, I mean, you name it, those have been really down earlier. You're off about 1.5%, erasing earlier gains that we had, given this energy crisis continues to roil some of the metals markets. And finally, cotton, you're up about 2% here. You're getting a supply outlook that's improving and lower demand as well that's coming from China. I know commodities close is typically one board. Quickly, though, let me just bring you to this terminal chart. It is nat gas. It's rising globally. Everywhere you go, it has gone vertical. That is a scary, scary chart, Caroline.
Energy prices going up, food prices going up, inflation. Let's talk about that at the moment, because live at the Academy Museum in Los Angeles, and restaurants, they're like the heart of what happens in LA, driving force in California's economy, with, of course, the industry suffering globally since the pandemic began. Labor shortages now making things even worse. You've got the demand, but suddenly it's the supply side hurting. Carolyn Stein is with us. She's the owner of the Look Group, now member of the International Restaurant Coalition, who, well, just opened not one, but 2 restaurants in LA this week alone. So known for fabulous food, fabulous wine at Luke, now gone on to open AOC in Brentwood. You've got 2 more and a new hotel complex here. What is it like opening in this labor in current environment?
I have to say, I've been in this industry for a very long time, over 30 years, and I have never experienced what we're going through right now. Normally we open restaurants, we have an enormous staff, actually too many people that we train, we open up, we're like bustling, and we're very, very full of staff. And we are actually struggling. Right now we don't have enough staff to even open all of our venues for 7 days a week. We don't have enough staff for brunch at one of our restaurants or lunch, and it really holds back our ability to open, operate, grow, and actually, create a bustling economic environment.
With regards to the labor, though, is it primarily servers? Is it cooks? Where's the shortage?
It's across the board. It's front of house, it's back of house. Sometimes I think the kitchen might be even worse off, because finding skilled labor, people who really know what they're doing in the kitchen, is really hard to find. And so we find that we're hiring a lot of people that don't have experience and having to train them from zero and try to get them up to speed. Front of the house, it's impossible too. Just getting support staff, servers, bartenders, and these are normally, pretty well-paid jobs because they get tips, and but now it's just impossible.
The Luke Group, of course, by its very nature, it's fine dining to a certain extent. You're able to charge a slightly higher price point than many. When you're looking at the new Cara Cara and Caldo Verde, which are opening, can you pass through cost increases? Are people willing? Because we're all kind of flush with cash. We've been saving.
Yeah, I have to say, that is a really fine line that we have to balance all the time. We're always very conscientious of what we're charging. We don't want people to feel that they're being gouged, but at the same time, the restaurant industry currently does not charge enough for what we provide. The cost of the food, the cost of labor, the cost of fuel to get the food to us, our energy costs, all of these costs have gone up dramatically. And the public just doesn't really have the tolerance for the increased price that comes along with that. And so we're constantly trying to do more with less. We're really, really sensitive to it. So we can't just pass it on through automatically. It's got to be very, very careful.
But the cost issues that you mentioned, obviously these were pre-pandemic issues as well. The pandemic did, I guess, provide maybe an ability to step back and look at that business model. Were there changes made by restaurateurs at all to that business model where maybe it made the margins a little bit more secure?
We've wanted to make a lot of changes to our business models. It's sort of like restarting a whole new system, and there are some people who have been very successful with it. We're trying really hard. We've been trying to include the back of the house, the kitchen, in the gratuity pool because historically, those who work in the back of the house are the lowest paid and actually work incredibly hard. So we're trying to balance that out. A lot of restaurants are doing service charges instead of gratuities. There are challenges with that too. It's a system that the roots go so deep and are so hard to make dramatic change. It's more about chipping away gradually.
You have, of course, been one of the key voices on a group of independent restaurateurs who lobbied the government to say, look, we're having a disastrous time amid the COVID pandemic. Now what? Are you looking towards the administration for help when it comes to labor, when it comes to educating people to want to get into your industry, when it comes to sort of rebalancing what sort of support some of the labor get there?
Yes, actually, we are actively lobbying Congress and Senate right now, and that is because back earlier in the year, in about May, they passed the Restaurant Revitalization Act as part of the greater rescue package, and it provided $28.6 billion to restaurants in grants, desperately needed grants, but only a fraction of the restaurants actually were able to get them because the money ran out. There are still about 100,000 restaurants that did not get these grants. So we've been desperately begging Congress to re-up that fund because this is really the lifeline that we need at the moment. We are facing the fall and winter. We don't know what's going to happen with any other variants that come along, with the current Delta variant. Here in Los Angeles, we deal with cold weather and rain, even though it feels like we don't get it, it does happen. And people are more reluctant to eat outside, but they're very reluctant to eat indoors still. And so we are not sure what we're facing through winter and all the way into the spring.
Well, give us a sense here of, what the restaurant scene in LA is like now at this stage in the pandemic here with regards, have numbers gotten back to say 2019 levels with regards to just the number of people coming into restaurants, or you're still short of that?
I think that the desire on the part of the guest is there. People are desperate to go out. They want to feel like it's old times. They want to have a meal cooked for them. They're tired of making sourdough bread at home. And they really want to have that experience. We are communal, social beings. We want to be in a room tightly with people. We want to be out. We want to get back to that. But a lot of restaurants may not be able to actually take all of these reservations and all of these guests because we don't have enough staff to serve them. We don't have all the supplies we need, and the public wants things to be normal, and we're having a really hard time providing normal again. So that's one of the great challenges too.
Yeah, it's a big challenge, and one day we'll get there. We were out and about. We got to a few restaurants, and people want to come back. Caroline, we wish you the best. Really appreciate you stopping by to be with us today. That's Caroline Stein. She's the owner of the Luke's Group, of course. ALC, what was it, Cara? I'm sure you've been to all of these restaurants, haven't you, Caroline?
I've got it lined up, Caldo Verde. Can't wait to stop by and support the new ones.
Well, that's very appetizing. We're going to pivot from that to Taylor's favorite restaurant, which is Chipotle. We're actually going to have CEO Brian Niccol joining us right now in the next hour, live from Los Angeles. This is Bloomberg.
the Academy Museum of Motion Picture. It's all about how movie magic is made.
Yeah, and there's a lot of magic on the walls there, a lot of glitz and glamour, the actors and the directors that we know. But there are a lot of people behind the scenes that we don't talk about much. The people behind the cameras, the people off stage who make it happen.
Makeup artists, the crew, now fighting for better representation, labor wages, and indeed, well, the way in which they work.
Yeah, and we're going to talk a lot about that today while we're out here in Los Angeles at the Academy Museum. And we're going to talk about, I guess, maybe some of the other issues going on with freedom of speech and freedom of content.
Yeah, Netflix, the recent walkout, we're going to dig into all of it.
Fun having them out in LA. In the meantime, back here in New York, we are checking some of the stocks that are having pretty good days. One of those is our stock of the hour. Take a look at shares of American Express, headed to its best day in almost a year after third quarter sales and profit topped street estimates. Bloomberg's Dave Wilson joins us now. Dave, you getting extra perks with all these Amex points?
Well, not yet, but I will tell you, I have gotten a number of solicitations for the Platinum card. That was a big deal for Amex in the third quarter and is a big reason why the company's earnings and revenue, not my solicitations, but the push for the Platinum card, why earnings and sales beat estimates. You know, you look at the numbers in terms of customers' use of cards, you're talking an increase of 37% from a year ago in dollar terms, and 10% just from the second quarter. So you can really say that spending is back after having taken a hit last year during the coronavirus pandemic. Now, all that comes at a cost. Sure, the Platinum card, you pay $695 a year, but, you know, Amex gives you access to private jets and, you know, additional credits on your statements. I mean, and all that comes at a cost. And so you're talking 27% of their revenue in the third quarter going to cover the cost of their rewards, throw-in services, and you're talking almost a third of their revenue going out the door for those reasons. Then again, I mean, you're talking about 22 cents of every dollar turning into profit, you know, which works to Amex's favor for sure. I should note the card reward expense is more than $3 billion in the quarter, which was higher than analysts were expecting in a Bloomberg survey. In fact, total costs at Amex up 29%. Now we turn to the income side.
Okay.
You know, people using their cards more. That means Amex makes more money from swipe fees. And so you're talking the 34% increase there, and those card fees with that $695 for the Platinum card, up 10%. And you put it all together, you got a 25% increase in revenue. And, you know, it's definitely better in terms of, you know, card issuers. Amex making out a whole lot better than, say, Discover Financial, which had results out the other day, and its shares fell. More like Synchrony Financial, which also had shares out this week, and stock was up. Capital One, their results due Tuesday, so we'll see if there's any carryover from what we're seeing out of American Express.
We look forward to Tuesday, and we'll make sure to get you back. Bloomberg's Dave Wilson, really appreciate it. Coming up, Dr. Patrick Soon-Shiong, the billionaire founder of Immunity Bio and owner of the LA Times and the San Diego Union Tribune. He is next. We're going to speak about the company's efforts to develop a new type of COVID-19 vaccine and to build a vaccine manufacturing complex, all in South Africa. This is Bloomberg.
We are live from the Academy of Motion Pictures in Los Angeles, and an extraordinary story, actually kind of driven by Bloomberg's own reporting, has been the employees over at Netflix not pleased, to say the very least, after the controversial Dave Chappelle comedy special featured, well, jokes, talk at the expense of trans people. Now, employees walked out of the company's headquarters on Wednesday, while co-CEO Ted Sarandos was defending the decision on air to keep and stand by the special. But this was all blown open by Bloomberg's own reporting that what they were paying the show for Dave Chappelle and the pushback on why it's remained on Netflix.
Yeah, and it raises a lot of broader issues too. When you have a platform like Netflix, which of course puts out so much content across such a diverse sort of range of topics and interests, you're always going to have a situation where maybe one person's comedy is another person's offense. It seemed like employees did actually go to Netflix executives at some point and say, look, maybe you shouldn't air this. They chose to do it, and they made it clear that they want to support the freedom of these artists to make what they make, and if there are consequences to that, they have to deal with it.
And Taylor, I think what's also interesting is sort of the culture at Netflix, because it's got a very transparent, sort of radical openness to it that shares documentation, pay of each other's pay, of deals struck with certain shows. The flip side of that was, yes, we'll share this with you, our executives will share this with the greater company, only if this remains in our four walls. But that was broken down recently.
Yeah, you know, and I think it's interesting, not only with Netflix, but it feels like big tech in general sort of sometimes have these crises, if you will, where employees, and then they organize employee walkouts after they have a lot of internal discussions with CEOs, with management over perhaps maybe issues or causes that they do or don't believe in. And feels like, I mean, I'm sure it happens at companies all over, but certainly within the tech industry, really feels like this happens a lot within well, at least Netflix for last week.
Yeah, and one thing that we're trying to get at here in our trip out here to the museum is kind of the intersection of all this. You know, you have the content creators, you have the platform, you have, of course, the people behind the scenes. And sometimes they're in conflict, and you sort of wonder, you know, how they manage to sort of, I guess, bring it all together so that you do get that final product in a way that is tenable.
And fair to all. I mean, we've just seen the avoidance of a walkout from more broadly the community that is behind the scenes in movies, you know, the camera people, the makeup artists, and that was managed to be avoided. But we sit here in LA on a day, of course, that we had tragic news of the movie with Alec Baldwin, where an accident occurred. How are these people being treated? Let's now pivot to a special guest who, well, covers the movie industry with the product that he owns, at least. Dr. Patrick Soon-Shiong is the founder and chairman and global chief scientific and medical officer of Immunity Bio. He's also the owner of the Los Angeles Times and the San Diego Union Tribune. And first and foremost, as a media mogul, dare I say, but a man who's helping foster media, particularly here in LA, what is it like to be able to focus and ensure that the right sort of news is still able to occur with the margins that make sense for you?
Well, I think, you know, the opportunity for us to take this brand of the LA Times, storied brand, and now convert it from just a newspaper to a news media organization is really exciting. And with Kevin Merida now from ESPN as executive editor, I think we will begin to see over the next few years this evolution of this newspaper.
With regards to just the appetite for that, particularly at a local level here in Los Angeles, and even when you go across the country and worldwide here, is that appetite, the consumer appetite, still there for that?
Well, I think we need to engage, right? I think you in Los Angeles, you can see this sports center of the country here with the Dodgers, the Lakers, the Clippers, the Rams. We are the music center, we are the food center, we are the entertainment center, and now obviously I think the West Coast leads in innovation in climate change. So there's so many areas that are specific to not just this region. We lead, I think, the nation and the globe, and an opportunity for Los Angeles Times to report on that and be the voice for the people here on the west side of the nation is really exciting. And there should be consumer
of course. Apologies to cut you off there, Dr. Soon-Shiong. What's amazing is, well, the breadth of industries that you cover, of course, helping continue to foster the world of media and news, but also the work you've done previously when it comes to fighting cancer, the work you now do to ensure that COVID-19 is more, the vaccines against COVID-19 are more accessible, particularly in emerging markets in South Africa, for example. Can you talk us through what you're focusing on there?
Yeah, you know, when I sold the company to Celgene into Fresenius in 2010, we embarked on a 10-year program in which we want to create this vaccine, not only for cancer, but also COVID. And this company now, Immunity Bio, which we've taken public, is the culmination of literally a decade's worth of work. COVID, we were already in about 150 patients with the National Cancer Institute with our vaccine in cancer, in which we're about to embark, frankly, on one of the first preventative cancer trials in colon cancer. So the data that we have now with pancreatic cancer, triple-negative breast cancer, lung cancer, and bladder cancer validates this concept that if you activate your immune system without high-dose chemotherapy, and an orchestration of molecules, you can actually change the paradigm of cancer. We're using that exact same approach for COVID. In order for us to actually address this pandemic in COVID, we really need to actually stop the transmission.
All right. Well, really important stuff here. I wish we had more time with you, Doctor. Really appreciate you taking time to be with us. That's Dr. Patrick Soon-Shiong, of course, the founder of Immunity Bio, and of course now the controller of the Los Angeles Times and the San Diego Union Tribune. We are out here in Los Angeles atop the Academy Museum of Motion Pictures here. Beautiful day here in Los Angeles.
Absolutely stunning. And this part of the museum has actually been open, but what, a couple of weeks or so? Absolutely wonderful new exhibits that you've got to come and see. But we're going to be
David Geffen Theater, just beautiful.
Yeah. Go on to Instagram, go on to Twitter, go and check out some of the behind the scenes that's going on right here in LA. Check out the markets as well over in New York. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets, The Close, with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
We are live from the Academy Museum of Motion Pictures. It is beautiful here. It is a special edition of Bloomberg Markets, The Close, Entertainment Edge. We're counting down to that close. Just 1 hour left in trading. I'm Caroline Hyde.
And we're keeping an eye on trading. We got a lot to talk about here, both in terms of what's happening in the market as well as outside the market. The director of this beautiful museum, he's going to be joining us a little bit later this hour.
Let's check in on what's happening with markets, though, as well, because Taylor, you're all over that, over in beautiful New York, too.
I am. I'm trying to be all over these markets. Let's get to it, as we do every day, taking a look at IMAP, of course, some of the winners and some of the losers. Here you can see it's financials, it's energy, utilities in the lead. That's interesting. You also have real estate in there. Bond yields are falling across the board, and so you're getting sort of a mix here. Technology, though, is clearly the laggard on the day, and that's really what's pulling down everything with it. Mattel's interesting. This was higher. It's a little bit lower now, but Truist Securities is calling this just sort of a nice reprieve from all the negative sort of concerns that we've been hearing about supply chain issues. Well, Snap also not having a good day, one of the worst days on record, of course, given A, supply chain, and also B, some of the impacts from the Apple iOS system. Intel's also an interesting story. Analysts are saying from Piper Jaffray, for example, Intel just continues to have a series of hiccups, but that means that it is good news for AMD, and you have AMD shares up about 0.4%. Caroline?
Yeah, and Taylor, the mood music, though, surrounding the markets today is one of, once again, focus on inflation. What does that mean in terms of Fed policy? Jay Powell perhaps raising the alarm that he's a little bit more worried about inflation than many had thought. Mary Daly of the San Francisco Fed also been discussing about, well, the economy, whether or not it can take an interest rate hike. Let's take a listen.
No one knows what inflation is going to be really next year. If we forecast that we're going to raise the interest rate now, and we even worse do that, then we've actually bridled the economy. And if we're wrong and inflation comes back down to 2, if the people who would propose that are wrong, then we've bridled the economy. We've left millions of workers on the sidelines, not able to come back in. And that's a cost to them. But the other thing I'd like to mention is it's a cost to us as an economy.
Mary Daly's button, almost as nice as yours.
It's very beautiful.
Yeah.
Did I start that trend?
I think you did start that trend. Own it, Romaine.
Yeah, I'll take credit.
Meanwhile, we talk about the trend of inflation, of interest rates, with our next guest. Richard Weiss is with us, CIO of Multi-Asset Strategies for American Century Investments. A cool $245 billion in assets under management. It's wonderful to be here, live in California with you.
Thank you. You know, I live here. I'm only 5 miles away. It took about an hour and a half to get here.
You say it's sort of like an experienced LA commuter. Hilarious how long it takes to get everywhere. But Richard, seriously, it's extraordinary how long it takes to get your goods to anywhere at the moment. We were just over at the Port of Long Beach yesterday. The worries about your furniture, about your electrical items, about the inflationary pressure that has. How is that affecting the way you invest?
Yeah, well, there's no question inflation's the problem of the day, right? A side effect of COVID. But the thing about COVID is it's an equal opportunity pain in the butt, right? It's affecting both supply side and demand side. So you have pandemic-related supply chain disruptions, you have pandemic-related pent-up demand issues, pandemic-related labor shortages, then you add oil and the weather on top of that all. And so, but each of these inflationary pressures has a different source, arguably, a different half-life, and a different remedy, potentially. Yeah. So we see them mainly as transitory, not all. The labor wage issue is clearly the dominant pressure at the current point, and Chairman Powell noted that in his comments. So we're watching that carefully.
Well, let's talk a little bit more about Chairman Powell and how the Fed reacts to this. You talk about the half-life. Some of those half-lives are pretty short. Some of them, of course, may persist for a little bit longer here. Do you normalize Fed policy in this environment, or do you wait for maybe a little bit more evidence?
I think according to the new platform, the FATE, right, flexible average inflation targeting policy, they're going to have to wait for it a little longer. I don't pretend to know exactly when. Obviously, they're tapering. That should be done by mid-year. Leaves open the opportunity, the window for them to hike as soon as mid-2022 if necessary. We don't see it coming before that, though. Again, the inflationary pressures are different ones. Many of them may settle down in the next few months.
Meanwhile, you have to weather the gyrations in the market. We've had extraordinarily low volatility, really, on average throughout 2021. But now we get these bouts of sudden movements in the S&P 500, one direction or the other. We're at a record high again, but we have suddenly pressure on yields, pushing that a little bit higher. What do you do in terms of a multi-asset approach? Have you been changing things from your investment perspective?
Certainly at the margin. We remain neutral on our overall stock bond allocations. You know, we see the glass is both half empty and half full. It's, you know, it's sort of a quantum mechanics kind of way to see it both at the same time. But
it's sort of like Arnold Palmer, where you mix the
exactly.
And ice.
Love the Arnold Palmer.
Going deep here.
But in your fixed income portfolios, I mean, here's really where you can tune it, dial it in a little better for inflation. So we remain shorter in duration, both importantly in nominal and real terms. So short-term tips, so you're covered on the inflation aspect and on the interest rate aspect. That's where we've done our major trimming. On the equity side, we're trying not to get too cute with how inflation
Can I just stop you there? Because so you're shortening the duration, but is the allocation still, in terms of dollar value, it's still there?
Yes, sir.
Okay.
Our stock bond allocation is standing pat.
Gotcha.
We don't hate equities, but we don't love them. So we're standing at whatever our neutral or long-term strategic allocation is for the particular portfolio we're talking about.
Okay, gotcha. And equities, go ahead.
So within the equity portfolios, again, we're trying not to get too cute by figuring out which sectors have pricing power, et cetera, because you don't know which of the inflation shocks are going to most affect the equity sectors, right? If it's oil, that's drastically different than if it's interest rate driven or supply shock driven. But we are leaning towards small cap stocks. They have not fully and fairly participated in the reopening, and so you have a valuation more attractive in that sector than possibly in the larger cap sectors. So that's where we're leaning.
What about inflation hedges outside the world of bonds and equities? I mean, is gold working for people at the moment? Dare I say it, cryptocurrencies, people are starting to talk about Bitcoin doing the same sort of thing. Are you looking at a more varied type of asset allocation now?
Yeah, you know, Bitcoin, I gotta love that. You know, gold, great safe haven. When the stuff hits the fan, gold is your only place to go, right? Or under your mattress. But you can't manage a portfolio to the worst case scenario. Bitcoin, look, I know gold. Gold's been around a long time. Bitcoin ain't no gold. That is not a safe haven, quite the opposite. So although it appears to do well when the panic hits the markets, I wouldn't bet on Bitcoin for a safe haven asset. Gold and silver, by the way, you know, are the two worst performing commodities this year, in deference to the fact that the economy is doing well. We're recovering, right? U.S. and global economies were very ill last year, no pun intended. We're recovering nicely. Obviously, we have a little fever in terms of inflation, but all in all, recovering smartly. U.S. economic growth this year is widely expected to be about 5.5% in real terms. Next year, maybe 4%. Think back 2 years ago, we would have killed for 4% real growth. So overall, we're doing well for a recovering economy, keeping our eye on the fever of inflation, as the Fed is smartly doing. So no reason to panic, certainly no reason to run to your mattress or gold.
Richard Weiss, great to have you here. Love your sense of humor. Richard Weiss, CIO of Multi-Asset Strategies for American Century Investments. Let him get back to his hour-and-a-half commute back 5 miles from here. Taylor, to you.
You know, we have the subway here in New York, so we can avoid some of those pesky commutes. Caroline, stay with us, because coming up, we're going to be keeping a close eye on the markets. We push towards the closing bell with John Buckingham, portfolio manager for Kovitz and editor of The Prudent Speculator. Plus, we'll be speaking with Chipotle CEO Brian Niccol, his take on the company's outlook for the fourth quarter, and white brisket, it's leaving the menu. And on the half hour, we'll be speaking with Kara Nortman. She's the co-founder of the National Women's Soccer League team, Angel City FC. With her partner, actress Natalie Portman, she is creating the first majority women-owned, women-led professional sports team in the U.S. All that and more coming up. This is Bloomberg. 45 minutes to the closing bell, trying to keep you posted on these markets. We're coming off the highs. Remember, it was a 45.49. That was the big record highs that we had yesterday. We're off just about 6 points from that. The Nasdaq and technology is the big underperformer today, which is really interesting because bond yields are actually falling. Typically, that's the relationship that we don't see line up. We see the opposite happen, but there is just sort of a broader sense of concern here going on with some of these big tech companies. We await those earnings next week. Volatility is pretty much going nowhere. Very, very low vol at a 15 handle. Let's do all of this and more in our options insight segment. 40 minutes to that closing bell, and let's get you up to speed with the day's options trading. Joining us now, Francis Stacey, Director of Strategy at Optimal Capital. And Francis, you know, with no vol, and yet we're still so near some of these record highs, what is this sort of climbing the wall of worry? It's the phrase that I hate, and yet it seems like we're in it every day.
We're in it every day. Well, what's really interesting is that even though volatility has been backing off of late, you had a little bit of an uptick in the skew from October the 5th through the 15th. So people are buying some out of the money protection. And so that's kind of climbing the wall of worry. Still, I don't see much selling momentum today, given the fact that we've just hit all-time highs. And I think markets have mostly priced in the taper conversation and think that Powell's going to start tapering in November. And markets are really pricing in, and balance sheets and earnings are absorbing these inflation worries quite nicely.
Let's talk about some of those inflation worries. Are you taking advantage of it through a trade? I know we've been looking at oil a lot.
Yes, so oil's interesting because oil has pretty low stockpiles at this point in time, with increasing demand. Now, if we had peak Delta virus cases in Q3, we have a potential for a reacceleration in growth from Q3 to Q4. Will depend, you know, the likelihood of that will be dependent upon Thursday's GDP number. But in that case, you have a lot of demand with these low stockpiles. The last time that occurred, oil went up to $100 a barrel. So
yeah, and we're seeing your trade here with USO, right? Can you walk us through that?
Sure. So the thing is that in the short term, oil is clearly overbought. So our trade is not going to be directional. It's going to be a straddle. We like USO. Make or break point is 56.25. Continues to close above 56.25. The probability increases you're going to get a breakout. Closes below that, you could get some downward momentum. So we're doing the long straddle, buying the USO December 17, 56 calls and puts.
Wonderful. Really appreciate your time. Next time we need more. Francis Stacey of Optimal Capital. It is a reflation trade that continues to remain in vogue. Stay ahead. We're going to talk about some of this inflation, maybe some of the food inflation, some of the labor, some of the wage inflation, and we're going to do that with Chipotle. We're taking a look at shares here, trading a little bit lower today after, of course, that chain. The top sales estimates for the third quarter, but what is coming next for the fourth quarter? We're going to hear about it all from the Chipotle CEO, Brian Niccol. But first, we'll grab some popcorn, maybe some more behind the scenes with Caroline and Romaine at the Academy Museum in LA.
The movie industry, TV, it contributes a lot to the US economy. More than $180 billion in wages are paid, 2.5 million jobs, not to mention, 90,000 companies that are supported by this.
Yeah, supported by that. And a lot of that is dependent, at least traditionally, on getting people in the seats of theaters like the one we're sitting at today, the David Geffen Theater at the Academy Museum in Los Angeles. But of course, it all starts with content and with all those folks here who make it.
We're going to be talking about the future of content. We're going to have discussions with media moguls. We're going to discuss the way in which you pay for content now and those creators. Perhaps a little bit of crypto, NFT action.
Are we going to talk NFTs today?
Do you go bring a popcorn?
I might.
Shares of Chipotle, certainly something that we're watching today, out with earnings yesterday. Really good, better than expected across the board in the third quarter. But does that mean maybe some concerns here for the fourth quarter, particularly as we've been talking about food inflation and wage inflation and some of these supply chain issues? We know this is a company, they already raised their prices 4% earlier this year. And get this, we're getting a plant-based chorizo with pea protein. No more cauliflower rice for me, but maybe I can have vegan chorizo. Let's do it all with Brian Niccol, of course, the CEO of Chipotle. And Brian, I guess talk to us first about sort of the fourth quarter outlook, some of the pressures that you're continuing to see, if any, really on the food inflation and some of the input cost inflation.
Yeah, sure. Well, thanks for having me. And yeah, you mentioned it. We're obviously really proud of the results we just delivered on the third quarter. Obviously, going forward, we're dealing with a lot of the similar challenges you're seeing across the industry. It's a really difficult labor market, and the supply chain continues to be, I call it under pressure. But one of the things that we're really fortunate is our company has tremendous pricing power, and we also have a brand that really stands for, food with integrity, a meaningful purpose that both our employees care a lot about and our customers care a lot about. So we're pretty confident about how we can navigate these headwinds over the coming months and really keep our long-term plans in place, which is, getting after $3 million average unit volumes, adding over 3,000 restaurants here in the future and having really meaningful earnings power and margins to go with all that.
Brian, you've been very transparent about, raising your prices, I think all in all about 4% higher, because you wanted to pay more for labor. How are you seeing, you say, of course, it's mission-based and people want to stay with you and work with you for that reason. What else are you having to come up with at the moment to attract new people to come and work with you and not move somewhere else or demand higher wages?
Yeah, look, one of the things that we hear with the new employees that have joined our company recently is the purpose is a big deal. We have to continue to do a really great job of communicating that, as well as the growth opportunity in our company. The idea that we're going to add 3,000 plus restaurants means you can go from being a crew member to a restaurant general manager to a multi-unit leader in a really short order. And that means tremendous professional growth and tremendous personal growth. So we need to make sure we get across the growth story for them as much as the growth story is for our company. And then obviously we got to keep an eye on wages and all the benefits that we provide. We want to be a leader. We want people to feel great and full of pride that they work at Chipotle, and we got to deliver the total package. So we're fortunate that we're a company that's based on a very simple purpose of food with integrity. And then we're also fortunate to be a company that has the pricing power and the balance sheet to move wages if we need to move wages and handle other input costs that may come our way.
So, Brian, on the labor issue, though, where do you stand right now with staffing? Are you where you need to be across all of your stores?
We're in a pretty good spot. The bulk of our restaurants are kind of the majority of our restaurants are staffed and in really great shape, both to run our digital business as well as our frontline business. We do have a couple hundred restaurants where we continue to be challenged with staffing, and they're kind of sprinkled across the country. So we're working very closely with our teams and our leaders in those markets to get those restaurants staffed. And, it takes different things to get them staffed. And we're digging into it and making sure that we're providing the right incentives to get people to join the Chipotle business where we are understaffed, and then retain the 100,000 employees that we currently have in our company. That's equally as important to us, to retain and develop the employees we currently have.
Can you talk to us about the strategy that you have? I know we joked about cauliflower rice earlier in the year, I believe it was, introducing it, taking off the menu, and of course the pea protein sort of to make up a plant-based chorizo item. You put it on the menu, and then are you going to think about taking it off? Or are you just sort of testing out the consumer appetite?
Yeah, so, obviously we've got tremendous ingredients, and I'm glad you like the cauliflower rice. I was a fan of that as well. I'm optimistic we'll be bringing that back at some point. But this plant-based chorizo is probably going to be a limited time offer as well. But I'll tell you what, it's fabulous. I had the opportunity to go test it out in a couple markets where we were testing it, and I'll give you an inside tip. Our chorizo with a little white rice and some queso in a burrito is tough to beat. It's really, really good. So, our guys that work in culinary do a terrific job. They do a terrific job, and we'll continue to keep our current ingredients, I think, delicious, and then we'll find our ways to bring on some new ingredients where it makes sense.
Brian, we were just down at the Port of Long Beach yesterday talking about the extraordinary things that are going on in terms of a supply chain. You just talked about, the difficulty navigating it, but the fact that you feel that you're on top. What are some of the most wild things you're having to do from an anecdotal basis to get things into your more than 3,000 restaurants, whether it be in the US, whether it be in Germany or the UK?
Yeah, look, similarly, I can see the Port of Long Beach from where we live, and it's pretty amazing to see all these ships sitting out there waiting to get in. But, we've had to do some things creatively where we forward bought a lot of goods to open our new restaurants. The team did a great job of buying additional HVAC and buying additional chairs and tables and such, so that, when we realized it was going to take longer to get these goods, we basically pre-bought them so that we could continue to open our restaurants at a really good clip. And then I got to hand it to our supply chain team. Our leader, Carlos Landano, he's done just a fabulous job of working with our partners, to bring great products like brisket, but also to keep us in stock with our chicken. And, we're in constant communication with our key suppliers and partners. And it's kind of like a every day, every week thing to figure out how you continue to keep the supply flowing and, keeping our customers happy and keeping our restaurants rolling.
Yeah, Brian, getting creative. We thank you so much. Brian Nichols, CEO of Chipotle. Stay well. Meanwhile, coming up, we're going to talk about female football. Angel
Soccer.
City football. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets, The Close, with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
Live from Hollywood and the Academy Museum of Motion Pictures, to be precise. This is a very special edition of Bloomberg Markets, The Close, Entertainment Edge. I'm Caroline Hyde.
Yeah, you can see Hollywood there in the hills. In the background here, we're overlooking Wilshire Boulevard, of course, and the Dolby Family Terrace. Atop the museum, we have about a half an hour left in the trading day. Going to get back to our conversations out here in Los Angeles, but we want to jump over to New York, also beautiful. Taylor, you keep an eye on the markets. What's happening?
Quick intermission here for some of these equity markets remain. We're trying to hold on to some of the records that we had within the S&P yesterday. We're mostly unch on the day. There's a little bit more green, though, on the screen than red, but because technology's in the bottom, that's sort of dragging everything down with it, despite financial, staples, energy, real estate, utilities, you name it, all in the green, because bonds are climbing, which means yields are falling. I mentioned technology, and wow, 100% on the day, the Digital World Acquisition Corp. This is that Trump-related SPAC. I think since it launched at $11.28, it's now at $91 a share. You're up like 1,300% or something in a few days. So that's certainly something that we're keeping an eye on to the upside. To the downside, it is Snap. That's a story that we've talked about pretty much all day long. Take a look at Beyond Meat. They're getting a reduced demand in some of their orders. They're talking a lot about some of these supply chain issues. So shares of Beyond Meat are off 12%. Chipotle as well. That's also one we hit, Caroline, though navigating some of those supply chain issues pretty well.
Love the intermission. Great use of the term, Taylor. Meanwhile, let's talk about California, the largest state economy in the United States. And our guest now knows a thing or two about pulling capital into Los Angeles and looking for opportunity in tech and actually far beyond that. She's actually Natalie Portman's business partner and co-founder of the first majority women-owned, women-led professional sports team in the United States. Cara Nortman's with us, Angel City co-founder. She's also, of course, experienced VC with Upfront Ventures managing partner, and also someone very focused on diversity with All Raise. Experience in e-commerce, the business that you first founded, not to mention the work with Barry Diller at IAC. Let's talk first and foremost about women-led sport. Totally changing the game here, and I love it. How are you making waves?
Well, we took a look around, started out as fans, and I went to the 2015 Women's World Cup in Vancouver and came and tried to buy a bunch of jerseys for my daughters. I have 3 daughters, as well as find content online. Couldn't find any of it. So I went on a multi-year journey to figure out why, and I'm happy to tell you more about that. But ultimately, we're making waves because one day Natalie Portman texted me and said, why don't we start a team? Why don't we buy a team? And Natalie and I had just gotten to know each other by supporting the pay equity fight for the players. The women's players in the United States were making, a fraction of what the men's players were making. And so we just started planning a bunch of events where Natalie brought her actress friends because they have these big Instagram followings and the like, and that it started with pure activism, and it turned into this butterfly effect that led to us starting the team, and ultimately more women owners coming in, media contracts, and the whole kind of business side of it taking off. But it really started with a friendship and fanship, as some of the players like to call it.
What's been the reception from the public, from the fan side of the equation?
It has been absolutely mind-blowing. I mean, I pinch myself still every time I walk into LAFC Stadium, which is where we're playing. I mean, it's there in the numbers. So we've just announced this week that we've sold 11,000 season tickets, which is more than several other professional teams in Los Angeles. We sold out of premium seats in 3 days, and so it is our community that make that happen, and that really helped us start this. We saw them in the stands with the sign at a men's game saying, "Bring the women to LA," and they've made it all possible.
It needs fans because that's where the money comes in. At the end of the day, the content has to sell to be able to reach this. That's always been the argument, hasn't it? Why women don't make so much in tennis. And it's interesting that Alexis Ohanian, of course, is a big supporter and husband of Serena Williams, but why women aren't making the same in all sports. And the argument's always been, well, you need the right sort of viewers to be able to earn. What's going to make the economics stand out that you can be like, this is why we should have equity when it comes to the amount paid?
Yeah, well, so sports really comes down to 3 primary revenue streams, which you guys probably know: sponsorships, ticketing, and media revenue. And so for years, I was running around saying, the way we pay the women more, why we do better in all of 3 of those areas. And people said, no. People don't want to buy tickets. People don't want to watch. People don't want to sponsor. And ultimately, we just had to believe that they were wrong. And the stat that I really kind of leaned into when I was starting the team with Julie Ehrman and Natalie Portman was that only 4% of sports coverage goes to women's sports. So if you don't know it exists, you don't know to buy a ticket, you don't necessarily go out and get the sponsorships dollars. So it's either a vicious cycle or a virtuous cycle. So we set out to say we could sell, and I think in our initial case we said at least 8,000 tickets. We would get sponsorships at a certain level, and the media revenue was on the come, but that was what would make these teams worth hundreds of millions or billions of dollars. And I'm happy to go through our numbers, but we've shown that in a couple of the revenue streams, as have others in the league.
It's interesting, we were talking to Byron Allen a few days ago at Milken, who's perhaps using a more aggressive stance to push for more advertising dollar to go to black-owned media. How do you see advertising dollar going towards and sponsorship dollar going to women-owned media, but brands and indeed, VC entrepreneurs? Is the tidal wave calm? Are we still talking about a tsunami that's like years in the making?
Yeah, I think from a business standpoint, it's fascinating because you have traditional sponsors that have come into sports, and we are fortunate enough to have many of them: Heineken, Gatorade, et cetera. You have new tech sponsors like DoorDash, who's our jersey sponsor. It's a 8-figure deal, the largest in women's sports, as big or bigger than some actually in the men's side of the league over multiple years. And then what we're seeing, though, is a whole new wave of sponsors come in. So we have people like Birdies and Ritual and firms companies like that have never come in and sponsored sport before, women's brands, and we know women's brands, women's consumption is much higher than men's. So we're seeing that change, and we're seeing it across the tech landscape, I would say, as well, more broadly. And then one quick thing we've done is we've really tried to show that mission and capitalism goes hand in hand and creates a virtuous cycle. So with DoorDash, for example, in every one of our sponsors, we donate 10% of the sponsor dollars into local community causes. So with DoorDash, we're solving for food insecurity, and we'll deliver 50,000 meals by the end of the year. In other places, we're creating pathways for women players to then go into the business side of the operations. And so anyway, you're seeing dollars go into women's sports in a way you've never seen it happen before, and alongside this mission component.
You're obviously a big part of that, Kara. Really great to see you.
Thank you so much.
Kara Nortman there, Angel City FC co-founder and Upfront Ventures managing partner. We are out here in Los Angeles, still counting you down to the closing bell out there in New York. Don't go anywhere. You're watching Bloomberg. This is Bloomberg Markets, the close. We're counting you down to the closing bell. Live, of course, from Los Angeles, atop the Academy Museum of Motion Pictures.
Yeah, we're talking about content. We're talking about that being king. We're talking about some of the labor issues that are hitting not just the world of content, but also restaurants. But also going to talk about what those supply chain issues mean for the world of investment, right?
Yeah, but let's talk a little bit more about what's happening in the markets here and get some perspective. John Buckingham, portfolio manager for Kovitz, joining us right now. He's also the editor for The Prudent Speculator. John, great to see you.
Thanks for having me.
Hey, we've been talking about, I guess, the one thing that's on everyone's mind, at least if you're an investor, and that's inflation. Whether, not just whether it's transitory, but whether it's going to have a material impact on how people allocate.
Right. Well, the interesting thing is if you actually look at the data, which we do, we're students of market history, you'll see that higher inflation rates is not a bad thing for the equity markets on average. Of course, there's always, divergence in the max and the min returns, but stocks have done well with higher inflation rates. They've done well with higher interest rates, and certainly interest rates are extraordinarily low today. So when I mean higher, interest rates, we're not talking about 5, 6, 7% 10-year Treasury. Interest rates are extraordinarily attractive at this level and make stocks really appealing.
Richard Boyce was on a little bit earlier, and he's sort of saying we're not getting cute, he used the turn of phrase, of trying to pick industry winners within this inflationary pressure because you don't know which part's going to pop next. Do you agree with that? Or are people looking to rotate and try and make advantage, or at least not lose out when you see inflationary pressures in energy or in food?
Right. Well, we have a broadly diversified portfolio to begin with, so we're not making major shifts in our allocation because of inflation. Obviously, our energy stocks have done very well. Some of our other commodity-exposed stocks have done well. A name like Newmont Mining, if you're interested in gold, which really hasn't had a massive move up. I know a lot of people are worried about inflation, but you might think gold would pop a little bit further. But of course, these days, cryptocurrencies are a way that people can express concern rather than just running to gold.
Hold that thought. We definitely got to get your thoughts on crypto here. That's music to our ears. All right, we're in conversation right now with John Buckingham, portfolio manager for Kovitz, of course, editor of The Prudent Speculator. Almost 1 p.m. out here in Los Angeles, 4 p.m. in New York. That means the closing bells are upon us. We'll be back in a moment, counting you down to the close from Los Angeles, New York, to our viewers worldwide. This is Bloomberg.
This is a countdown to the close, live from the Academy Museum of Motion Pictures. It's a beautiful day here over in Hollywood. I'm Caroline Hyde.
And I'm Romaine Bostick, of course, keeping an eye here on the markets. Relatively unchanged day pretty much across the board. Taylor, give us a quick check of what we're looking at.
Yeah, unchanged on the S&P 500, and typically I do the lines chart for this, but I actually wanted to show a weekly chart. Despite some of the big losses that we're seeing within technology, the SOX and the FANGs today down about 1 to 1.5%. You're still up for the week across all the major averages for the second straight week. So we are still posting some back-to-back gains, Romaine.
All right, still with us right now is John Buckingham, portfolio manager for Kovitz and the editor of The Prudent Speculator. John, thanks for being patient with us. Let's get back to the conversation. We left off, you kind of touched on cryptocurrencies. There's a broader, I guess, conversation there to be had about risk taking in an environment where monetary policy is still, I guess, distorted, for lack of a better word, even fiscal policy to a certain extent.
Right. Well, I'm still a partial to equities in this environment. I think that the Federal Reserve has still been very supportive of the financial markets, of course, and that interest rates are still likely to remain low, even if rates do move up somewhat. So in terms of asset allocation, I'm not making big shifts or anything like that. I still think stocks are very attractively priced. When you think about things from, say, a dividend perspective, our portfolios are yielding 2 to 2.5%. And think about what you're getting on a bond portfolio or what you're getting on, say, a super safe, quote unquote, 10-year treasury at, a 1.6 or so. I mean, stocks are really attractive from an income perspective.
How do you hedge, though, that risk that we start to see perhaps a move quicker than we'd anticipated with the Fed and the IMF talking about bouts of volatility, a potential sell-off in risk assets?
Right. Well, that's part of the process. Volatility is normal. 5% declines happen 3 times a year on average. 10% declines happen every 11 months. So the way we focus on it is looking at getting the asset allocation right in the first place, ensuring a long-term investor is invested properly. And so stocks, for those who have a multi-year time horizon, I think are going to do just fine here. Not without some ups and downs, of course, but certainly no reason to dump stocks and buy some other asset class. Yeah. And again, where are you going to go these days with yields so low?
Well, without getting too into the whole issue of market timing, I'm sure you have to have your eye on kind of the broader macroeconomic picture. And there are a lot of people trying to guess where we are in this economic cycle, and I guess that feeds into the market cycle here. I mean, the economy, at least as it stands now, pretty much defied a lot of expectations within the pandemic and even coming out.
Exactly, and that's the whole point, I guess, we would make, is that people were very frightened about economic growth, corporate profits, heck, the election. A year ago at this time, that was going to be the end of the world if a Democrat won the White House, and then if we had a democratically controlled Congress. Obviously, that hasn't been the case, even though that occurred. Stocks have done just fine. So I think equities are a great place for, again, long-term money. Short-term, who knows what's going to happen in the near term. Remember, September was a dismal month. S&P 500 had one of those 5% declines, and all of a sudden now we're sitting here almost at an all-time high, very close to that famous Dow 36,000 number that James Glassman, pontificated back in 1999.
I remember those. There were a lot of hats printed out, if I remember correctly.
And now we're about to hit it. I wonder where the hats are now. They're all dusting them off.
I bet you those hats might be worth in the Dow.
Maybe you can make an NFT out of the hats. And anyway, John, we digress. I'm interested in how you convince your clients to remain invested, therefore. Is anyone wanting to keep powder dry? Is anyone wanting to get into cash? Is anyone nervous?
Well, everybody's nervous all the time, right? And we're nervous, of course. But the way you keep clients calm is we try to provide data. Again, we're students of market history. And when you hear people saying, well, rising interest rates are bad for stocks, well, that sounds good from a textbook perspective, maybe, but what's happened this year? The 10-year Treasury started below 1%. Now we're at 1.6. Equities have risen despite.
Are we in unprecedented times to a certain degree or not?
Well, we're always in unprecedented times. I mean, you never step in the same stream twice. It's always something different. But again, history is a guide, not the gospel. And when you look at what's happened with higher interest rates, with higher inflation rates, even Fed tapering, everybody, that's a boogeyman now for people. But you go back to 2013, 2014, we actually had a threat of tapering, and then Janet Yellen's Fed actually did taper, and the Russell 3000 Value Index made 50%, 50% for that 2-year time span. So lots of things will scare investors, but try to take a calm view of things. And boy, that compounding, you need to let it work for you. We're going to get to Dow 50,000 in 7 years if we just have a normal return from where we are today. Not an excessive return on the Dow, just normal.
New hats.
New hats. What about just with overall allocations? I mean, we have a lot of conversations about the traditional 60-40 portfolio, 60-30-10, however people want to slice and dice it these days here. A lot of people say they're still sticking by that. Maybe the duration on that 40 is a little bit shorter, but the actual allocation on a percent basis still remains the same.
Well, we kind of look at it and say maybe you want to do 120 minus your age for your allocation, rather than the old school, which was 100 minus your age. But again, people are living longer. People need income from your portfolio. So let's say, okay, I want to get out of equities and I'm going to go into fixed income today. I mean, yes, bonds are safer, but interest rates are likely to rise, and that's going to, hurt the price of those bonds. Obviously, you hold them to maturity, you get your money back, but you can certainly have a very lousy real return because of the inflation that we're seeing. So I think equities are going to allow you to keep up with inflation. For most investors, they should be the lion's share of their long-term allocation. Short-term, yeah, cash and safer things, but long-term, I think equities are the place to be.
Love the long-term perspective, really nuanced. John Buckingham, portfolio manager for Kovitz. Taylor, all about that 60-40. So what are you watching in terms of the world of assets?
Yeah, we're taking a world at the markets and also taking some look at breaking news that we have here. Bristol Myers Squibb, we're here, and has expressed interest in acquiring a rival biopharmaceutical firm, Urania Pharmaceuticals. This is according to people familiar with the matter. We have no indication on the price, but all we know really is here this smaller company specializes in therapies for severe autoimmune diseases. This is according to their website. So looking at acquiring this firm, but really trying to figure out exactly perhaps maybe what a price would be, if any. It is a Bloomberg scoop, so very well done here by our Bloomberg team. Let's just take a look at some other movers that we're following. I've been talking a lot about this stock today, shares of Beyond Meat, but it really just highlights some of the supply chain issues. They're saying that they saw a decrease in retail orders that persisted longer than expected because they had a distributor that, well, didn't really match up to some of the labor needs. So that is a labor shortage that is underway. Shares are off 11.5%. And why? Well, inflation. Take a look at this chart. We're tracking 5-year and 10-year inflation and sort of break-even expectations. You're at a 16-year high pretty much across the curve. This highlights the pressure that we continue to see not only on the supply chains, but some of these input costs as we get earnings that trickle out. We're moving you closer to the closing bell. Full market coverage. It is happening right here on Bloomberg. We take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde out in Los Angeles. Taylor Riggs in New York, counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast, joined now by Carol Master and Tim Stenovic, bringing together all of our audience across radio, television, YouTube, and beyond.
Yes, indeed. And I got to say, on this Friday, I'm watching the financials. Best performing major industry group in the S&P 500. Thank you, American Express, because that stock hitting an all-time record in today's session. Revenue beating estimates. People are spending on goods and services, whether it's clothes, electronics, big time. And they saw revenue topping estimates. So very upbeat report. And that has really, Tim, pushed those financials higher today.
Yeah, on the flip side of though is what's happening on the Nasdaq, though. I've got my eye on social media and tech stocks. Snap's underperformance, and I'm going to talk about that in just a few minutes, dragging down a lot of tech and social media companies. We are seeing that Google's lower, Intel also being dragged down, or dragging down the Nasdaq right now, Facebook and Amazon as well, Taylor.
Yeah, you know, Tim, it's really interesting you talk about that because technology has been the big underperformer today despite yields falling. And it was sort of accelerated, Caroline, with some of the Fed comments that we got this morning out of Jay Powell. We had a really great conversation between him and Francine Lockwell. He's sort of reiterating that we're on for a taper, but really clearly noting that some of the inflationary expectations and bottlenecks are clearly priced to the upside. Yields really rally on that news, but then tech underperforms.
Yeah, a little bit worried about the reaction function of the Fed, whether they will be forced to act that little bit faster than anticipated. Also, we had Mary Daly over at the San Francisco Fed, too, saying, look, this interest rate environment not quite ready for us yet.
Yeah, not quite ready for us here. We are getting those closing bells. You can see that on the board there for our television audience, 35,677, not quite that 36,000, but we're inching closer to that, up about 0.2% on the day, 74 points higher here. The S&P 500 looks like it's going to close in the red, 4,545, let's call it, down about 5 points or about 0.1% here, coming off that record high. The Nasdaq Composite also lower here on the day, down about 0.8% here, down about 125 points. And of course, we always keep our eye here on the Russell 2000. We can flip up the board and go to that because we talk about sort of the underperformance or the potential outperformance here of that cyclical sector. And on this day, you take a look at that Russell 2000 and wow, Carol.
Yeah, exactly. And speaking of wow, man, if you were a bull on Aurinia Pharmaceuticals, just what was it, about 13 minutes before the closing bell, Bristol Myers said to take a takeover approach to Aurinia Pharmaceuticals. That stock just shot up almost 27%. Our Ed Hammond breaking that story. So that was certainly one of the outperformers. We continue, Taylor, to see M&A on track for a record year. We continue to see those deals, or even talk of those deals, coming in.
Yeah, really crazy. And you know, you talked about another stock that we'd mentioned as well, shares of Amex. For the radio audiences, we do every day. We look at the sector winners and the sector losers. And Carol, you're right. It's dividends and it's banks. Despite yields falling and a flattening of that yield curve, those two sectors are the best performers. You're up 1.5%. It was our stock of the hours. We were talking about maybe some of the benefits from the platinum card really coming out to help that company. Just quickly to the downside for the radio audience for some of the sectors, it's media and it's semiconductor chips. Carol, dare I say it? I mean, it's Intel and it's Snap, all as we approach some of the big tech earnings next week.
What's that American Express card? Platinum now?
Yeah,
Is it like $675, I think, a year? Let's get to some of the gainers. DWAC. Digital World Acquisition Corp, a company we weren't talking about a few days ago, but the past two we certainly are. Soaring for a second day, the SPAC blank check company has skyrocketed as much as 1,225% since an announcement that it will merge with Trump Media and Technology Group, so soaring another 107% in today's session. We did see roughly or even more than a dozen trading halts during the session as a result. Also, Portillo's, guys? It's a hot dog and hamburger restaurant. It made its trading debut today, up almost 29% in its first day of trading, soaring, having a much better first day of trading than yesterday's IPO of Vita Coco Co., which dropped about 10% yesterday, but rallied a little bit today. And then Mattel, want to bring that in as well, up about 0.6%. It was up as much as 8% in today's session. Third quarter results exceeding expectations. They're working through their supply bottlenecks. They raised their full year guidance. We're going to actually catch up with the company's CEO in just a few minutes right here on Bloomberg Radio, Tim.
Oh, you got the gainers. I got the decliners. Starting with Snap. This is the big story of the day. We covered the earnings live yesterday. The stock taking a tumble today. Shares sealing the record one-day decline, finishing the day down close to 27%, 26.59%. The company warning that Apple's data collection rules as well as supply chain issues weighing on advertising spending. Why are large companies going to advertise if they have trouble getting those products to consumers? Also potentially cutting their ad budgets as a result of higher costs. We're going to keep an eye on the shares of Facebook closing lower, also shares of Twitter closing lower as a result. We'll get earnings from those companies next week and get some more details. Intel shares weighing on the Nasdaq. The company saying profitability is going to take a hit over the next few years due to increased spending on Intel's manufacturing technology. This is about the turnaround. The company, though, finishing the day down more than 11.6%. Intel CEO Pat Gelsinger saying that he's focused on the long term and investing to maximize the long range of the business. Finally, Beyond Meat taking a hit today. Shares finishing the day down by more than 11%. They were down as much as 16% after Beyond Meat reduced its revenue guidance for the third quarter, setting a decline in retail orders, operational challenges, and then ongoing impacts from COVID-19. Retail has been really important for the company, especially during the pandemic. But apparently the taste for Beyond, the demand just isn't as much as it was about a year ago.
You're fighting words.
I'm sorry,
Tim.
Taylor. I knew you wouldn't like that. You got to eat more.
I'll give you some fighting words, and then we're going to do tech next. I'm going to do yields first, but Tesla is almost as big as Facebook. I'm just going to let you digest that from a market cap perspective while I take a look at where we are on the yields. And what's crazy is this actually totally hides the action. What you guys don't, well, and maybe you'll remember, Tuesday, Wednesday, Thursday, big, huge up in yields, and then today a big rally. So it kind of looks like Unch on the week. You're still down, or, well, I guess you should say up about 6 basis points or so. But Romain, this really hides some of the intra-week volatility that we got. We're really worried about inflation, but then Powell comes out and says, yeah, he's perhaps maybe looking at it too, and you get bonds catching a bid.
Yeah, I think a 1-2 on the 5-year. Definitely something to keep an eye on. Of course, next week, we're going to keep an eye on earnings. Of course, probably the busiest week of the season, at least for the large cap companies. And more importantly, it's a lot of those big tech companies. I mean, maybe we should stay out here in California for another week.
Are you guys ever coming back?
Never coming back.
Companies.
You're never coming
back.
back.
Yeah, we're paying rent soon, it would seem.
Yeah, I know.
Hey, for a week, but what a day to be here. Like in LA, Santa Monica, super close. And think of the move, the record move in Snap. You were just teaching us so clearly, Tim, about the maneuvers there. The impact of Apple, we are going to see that, of course, hit the likes of Facebook. You're going to see it hit the likes of Twitter. What was it? $150 billion wiped off of market capitalization across that that sector. Moves in one company's business model are having the ramifications across the ad business for all of them.
Yeah, I think what's caught investors off guard was that this was a thing that Facebook had talked about for quite a while, and an issue that Facebook had talked about for quite a while. But Mandeep Singh made a really good point that Snap's advertisers are a lot of big companies, whereas a company like Facebook relies on small businesses for advertising, so perhaps couldn't see potentially as big of a hit, at least when it comes to those supply chain challenges that Snap referred to, because those smaller businesses are not seeing those same supply chain challenges.
Can we talk about that? It was MoffettNathanson, Michael Nathanson, put out a huge report on that, saying that they were sort of talking a lot about Facebook's impact from the Apple iOS change, because Facebook said, yes, we're warning people, yes, we're worried. And they're coming out and saying that Snap has consistently downplayed this concern. It hardly came up. They were praising Apple for these changes. And then you get the news like yesterday and everyone's like, what? You told us this wasn't a problem.
But it's interesting. It plays into this bigger picture. Like, we know that, Caroline and Romaine, you've been out there on the West Coast. You see the port problems. Demand is strong. We saw it in the Amex numbers. We see it that consumers are out there buying. It's just those supply chains are preventing that demand being met here. And that's what's going on. That plays into Snap. Why would you advertise, right, if you're not going to be able to meet demand? So it's this interesting conundrum that economy doing okay, there is demand, consumers are shopping, household balance sheets are stronger than ever, but yet that demand can't be met.
Yeah, I mean, one thing we learned out here yesterday with regards to demand, all the disruptions we talked about at the port, they're still on pace for a record year, just in terms of what they're taking in. So they're certainly not hurting in that regard.
Yeah, but you perhaps don't want to be going out and trying out new modes of communication with your buyers. Yes, you might stick to your true and trusted Instagram, Facebook, but are you going to go into the new avenues? Are you going to go into TikTok? Are you going to go into Snap when you're going to run out of goods? You can't be committed to the amount of volume that you're going to be able to put on the shelves.
What are you guys learning out there in LA? Is it supply chain? Is it Netflix? What are we doing?
It's really hard to travel. That the traffic is terrible. That's what we've learned. That's another key one. That the labor shortage in the restaurant.
I mean, just so everyone knows, I mean, this is real on-the-ground shoe leather reporting that we've been doing out here in Los Angeles all week. And we're really getting a nice read here, not only on the economy, but really on the idea here of sort of what the next step is, how people are investing. Is that serious enough? Yeah, we did.
I was wondering where you're going with that. I've seen your Instagram, Romaine. It looks like you're having a little fun too. Okay.
I almost had you.
I just want to know. I just want to know. Has everybody had the Chipotle brisket?
No.
See, look at that.
We've been eating a little bit more high level than that.
Oh, okay.
I think.
Posh.
Should
All
I
right,
say that out
guys.
loud?
Don't tell the bosses.
Have fun.
It's
Safe
Friday
travels coming back to us. We look forward to having you back on the East Coast. All right, that's going to do it for Beyond the Bell. Our cross-platform coverage on radio, TV, and on YouTube. We'll see you again. I think we'll all be back on the East Coast. That'll be on Monday.
And more markets coverage. It's coming up. Caroline and Romaine are going to sit down with Bill Cramer, director and president of the Academy Museum of Motion Pictures, really after a successful launch to the public in September. This is Bloomberg.
This is a special edition of Bloomberg Markets to Close. We're live atop the Academy Museum of Motion Pictures in Los Angeles, the largest museum in the U.S. that's devoted to the arts, sciences, and artists of filmmaking. Now, after many delays, it finally opened its doors to the public. This is back on September 30th. Joining us right now is the man behind this museum. Director and President Bill Cramer joining us right now. Bill, thanks for having us here.
Hi guys, thanks for being here. We're excited to host you.
Well, I'm sure you have to be excited to actually have this open, and I assume that had to be a bit of a challenge given the pandemic is still here. How was it?
So the pandemic forced us to move our opening a few times, but we were able to keep construction going throughout the pandemic safely. And we opened on September 30th at 50% capacity with COVID protocols in place, and we've been sold out every day. People have been waiting for this museum for 92 years, so they're ready, and they're coming.
And they're coming, the demand is there. What about the philanthropic giving? What about the way in which that this came to be? Have people been wanting to within a tense time for health and indeed the economy, willing to sort of support these sorts of institutions?
Yeah, absolutely. We closed our $388 million capital campaign last November, so in the middle of the pandemic.
Amazing.
We've had incredible support from the industry, Bloomberg, many other places. So people know that there is value in a cultural institution devoted to movie making. LA's needed this, wanted this for a very long time.
Well, let's talk about movie making. It's changed a lot, of course, from the days when we were kids. You went to a physical theater to watch some big budget movie, or maybe an art movie. Now people have the option of pulling up Netflix, Hulu, or whatever streaming service and watching, in some cases, the same thing that would normally be in the theater. How has that changed the industry?
Both are important.
Yeah.
I mean, the Academy Museum believes deeply in the theatrical experience. We're sitting on top of a 1,000-seat theater right now, and we have another 288-seat theater. So every day we have several screenings of films tied to our exhibitions, series, programs, genres. But Ted Sarandos is the chair of our board. So we know that we live in a world now where streaming offers an incredible amount of viewing opportunities. Emerging artists can have their films seen by so many more people around the world more quickly. But we know that the theatrical experience won't go away. And it's really important to see films in the setting in which they were designed to be shown.
What about the support system for the ecosystem, whether it be the labor in particular at the moment? And indeed, there's been controversy around movie making, whether it be lack of diversity, and then whether it be the sort of the support from a wage point of view, but also a healthcare point of view for those that are helping make these films, not just be on the front of camera and the stars.
That's right.
How do you feel the moon music is in LA and for the industry right now?
So one of our goals in the museum is to tell the diverse, inclusive, equitable stories of our history, our legacy, the arts, the artists. And in all of that, we're creating a safe space to talk about these issues. The industry has sometimes been less than positive about equity and pay grades, and there's been racism and sexism and oppression, and there's also been a lot to celebrate. This is a place where we can talk about all of those things. That's how we build a better future, by addressing and not erasing and creating a safe space for those discussions.
With regards to that diversity and the push that we've seen to make the Academy more inclusive, to make Hollywood more inclusive, the entertainment industry more inclusive here, has the feedback that you've gotten from either your members or from other folks who maybe been supportive of the overall mission, are they on board with this?
Absolutely.
Yeah.
Our core exhibition is called Stories of Cinema, because there's not one story of our history. So they're really behind the fact that we're rotating many different stories through our core exhibitions that allow us to tell a multitude of stories, highlight many different artists, craft areas, and I think people are hungry for these discussions. We've had a lot of reckonings over the past several years. I think people expect a more diverse and inclusive view of our history.
And it's not just about history, it's about future now. And you're embracing that. You've started your own non-fungible token launch, NFT,
Yes.
raising funds in a new way. Talk to us about it. Why do you went that direction?
I think one of the many things that the pandemic has shown us is that cultural institutions, arts organizations, nonprofits, really need to diversify their base of support. So many of our peer organizations, within 3 or 4 weeks of the shutdown last year, laid off staff, furloughed staff, closed, because their ticket sales, their earned income stream just stopped. And there was no buffer from a contributed revenue side or an endowment or board members. So we're always looking at appropriate and interesting ways to bring in a diversified base of support. And the NFT that we just issued with the Haas brothers is one way of doing that. And we're extremely excited about the future of that.
All right, we walked around this museum. We saw, I think you met Bruce the shark.
Yep.
You met Bruce, great. He's hard to miss.
Yeah, 25 meters.
Here. What's your favorite part of the museum?
We love all of our children equally. I've said that so many times at this point. I have to say I'm most proud of the galleries that we've co-curated with incredible Academy members, film artists, Spike Lee, Pedro Almodovar, Ben Burt, Hildur Guðnadóttir, the composer. These are personal environments that we've built with them that really tell the story of their filmography, their interest, their aesthetic. You can really only see that here.
Bill, great to have you, and we really appreciate you hosting us today. That's Bill Cramer. He's the director and president of the Academy Museum of Motion Pictures, where we're sitting right now, right here in the Dolby Family Terrace.
Absolutely beautiful. I love Bruce.
Absolutely.
He's my new best friend. The Mechanical Shark, the only one remaining from the real film of Jaws.
Look at you. You're just a font of knowledge.
Yeah, 25 feet long. I had to change that, though. Time now for the First Red News. Mark Crumpton, take it away.
Caroline Romaine, thank you very much. The battle over a strict Texas abortion law is headed to the highest court in the nation. The U.S. Supreme Court has agreed to hear arguments in the case. That leaves the law in place for now. The decision to let the law stay in effect came over the dissent of Justice Sonia Sotomayor. The measure bans abortion after about 6 weeks of pregnancy before many women even know they're pregnant. The United States posted the second largest annual budget deficit on record for 2021 as pandemic relief spending sustained the federal government's massive borrowing needs. The Treasury Department says the deficit for the fiscal year through September was $2.77 trillion, compared with the $3.1 trillion peak seen in the previous year. The resulting gap was $897 billion less than forecast in the administration's budget outline earlier this year. Actor Alec Baldwin says he's cooperating with authorities investigating his firing of a prop gun that led to the death of a cinematographer on a film set. The film's director was also wounded. On Twitter, Baldwin said, quote, "There are no words to convey my shock and sadness regarding the tragic accident." Baldwin is a producer and star of the Western film Rust, which was being shot in New Mexico. Production has been stopped. No charges have been filed. We will have more on this story coming up. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Now, as we wrap up our week in Los Angeles, we cannot overlook the current mourning that's in process here in the industry after the fatal shooting on the set of Alex Baldwin's upcoming movie. This, as we continue to see growing unrest in Hollywood, in an industry still reeling from COVID-related closures and health restrictions. We want to recognize the recent protests at Netflix over the controversial Dave Chappelle comedy special, for example, and a new labor agreement between Hollywood and studios, one of the industry's most powerful unions, and whether or not that will stick. Joining to discuss all of this on a rather extraordinary day for the industry is Chris Palmieri from Los Angeles. And I mean, reporting happening all the time as to Alec Baldwin's accidental shooting of a member of crew, and sadly a fatal outcome there. What's the latest, Chris? And it looks as though once again this is a safety issue that people are trying to vocalize here.
Yes, Alec Baldwin said, he obviously apologized profusely, said he was devastated, said he's cooperating with the police in their investigation. The police have said that he was holding this prop gun that went off and killed the director of photography and wounded the director of the movie yesterday afternoon in Santa Fe. The sheriff's department said they're investigating. They're still trying to figure out what exactly exited the gun, or whether it was a bullet or shrapnel, as some people have suggested. I've seen both explanations. They haven't said either way. They haven't, they haven't pressed charges in any way. There's a lot of discussion on social media in the Hollywood community about what this means going forward. There's a lot of people complaining, saying we don't really even need prop guns on sets in the post-production, as it's called. They can recreate a muzzle shot, the sound of a gun going off. They don't need to take these chances.
So, Chris, there's also been a lot of discussions here about the working conditions on that particular set, as well as the working conditions on other film sets. One of the main unions that represents a lot of the folks behind the camera has issued a statement as well on that. What do we know about some of the demands that they've been making and whether some of those issues have actually been addressed?
Well, in fact, the people involved here were members of IATSE, the union that narrowly averted a strike last weekend, and they still have not settled their contracts. I mean, their president said represents some 60,000 movie industry workers across the country. Said, he was happy with what they got. They were complaining. They were vociferous that they were going to go on strike. They got increases in pay as much as 60% for some of the lowest paid workers. They got commitments, for meal breaks, and most importantly, a big issue is that they've been working over the weekend. They called it Fraturdays, where they get called very late on Friday and working through the weekend. And now they've got sort of commitments from all the big studios to have mandatory time off so that they can sort of rest and go back to their lives. So they want a lot. The contract is still not formalized. There's a lot of discussion still. Some of the younger members in particular are sort of more vociferous about, they weren't, told what the terms were. There's going to be more discussion and education over the next couple of weeks. They haven't set a date for a final vote, but that will be the final step.
Yeah, Chris, as you're talking, we're showing, of course, some of the components of the labor union agreement that we got between Hollywood studios and, of course, one of the most powerful unions to talk about working conditions. And, of course, talking about some of the wage increases. As we know, Caroline and Romain are out there talking a lot about supply chain and labor shortages and wage increases. Talk to us here about what we know.
Well, I mean, this as we're seeing this moment, labor is across many industries. People have gotten accustomed to, say, working from home or maybe not working as often as they did before, and so it's a challenge for all industries, Hollywood included. In particular, Hollywood's been trying to ramp up production while the shows that it had to stop due to COVID-related closures. And so that's been a big pressure point as all of these big companies, Disney, Netflix, try to get more TV and movies so they maintain the subscribers growth that they've been showing.
Chris Palmieri, thank you as always. Really appreciate your time here, of course, as we tackle a wide variety of issues. We've been tackling all of them on Bloomberg Markets The Close, and that coverage is ending, but make sure to stay tuned because what you missed, it's coming up next. We're going to be wrapping up the afternoon at the Academy Museum of Motion Pictures. We venture capitalist Elise Colleen of Stillmark and Rowan Gargozu, founder and CEO of NFT startup Dapper Labs. That's all coming up next. This is Bloomberg.